to the Charts and Patterns Recognition course. I'm extremely excited for you because regardless of whether you're a brand new trader or whether you're an experienced trader, I truly believe that what I'm about to share with you can really create some phenomenal trading opportunities for you. Specifically, what this course will focus about on the main purpose of this course is to help you identify profitable TROs. And I'll tell you in a minute what those are. And we're going to help you do that by utilizing charts and patterns, by discovering divergences in the market. Now, to me, trading without charts is like, trying to look up directions without Google Maps in a place where I've never been. And the reason I bring that example is because I want reading charts to become a natural habit for you, okay? I want reading charts to become a natural part of your process when you're looking through your trading ideas, when you're looking for identifying entry points, exit points, when you're looking to create some phenomenal trading opportunities. This has to be a part of your natural habit because it will provide you with greater accuracy. So with that, I'd like to say this, that stock charts will definitely show you the way. So first and foremost, I'd like to discuss the table of contents. Okay, number one, we're going to identify what is actually TRO. We're going to talk briefly about charts and time frames, candlesticks interpretation for identifying TROs, understanding trend lines, volume, velocity, VIX. We're going to focus on three proven indicators, RSI, MACD, accumulation, distribution. We're going to talk a lot about divergence with tons of examples. We're going to talk about 6 important types of divergences, black candle phenomenon, understanding depth cross bearish reversal with ton of examples, top 3 bearish patterns to short stocks, examples of head and shoulders, examples of double top, examples of loss of momentum. Basically, throughout this course, you will learn not only how to read the charts and know what are some of these indicators are, but being able to apply them in real life, being able to identify trading opportunities by discovering the divergences between the price action and what the indicators are actually telling you. In other words, we will show you how to read the charts between the line. Before we begin, let me say that if you've been trading for some time and you understand the basics of the candles and the RSI indicators and so on, make sure you do not skip this part of the course. It is crucial that you watch the entire course because I will specifically discuss how to use some of those things in the context of trend reversal opportunities. And I will simplify things so this information will be actually easy for you to use. So with that said, please grab a pen, get a piece of paper, get a notebook, and as we go through the course, get ready to take notes. After you have reviewed the course, because of the number of examples that this course is packed with, make sure that you go back and when in the future you try to look for certain trading opportunities, you can actually use this as a good reference guide because a lot of these charts you will notice they have some similarities. They have some things that will repeat from time to time. So as you're looking and analyzing some of the stocks that you like to trade, some of the stocks that on your watch list, let's say for tomorrow, for next week, this is going to be a very powerful reference guide for you to go back and review some information. So what is a TRO? TRO is a term that I use to define a trend reversal opportunity. Again, the main purpose, what I really want you to gain as a result of this course is being able to identify highly profitable trade reversal opportunities. Now there's 2 of them. I drew them right here. The first one is this. The first one is when a stock or a market continuously keeps climbing and climbing and climbing. Well, as you know, with the stock markets, just like with everything else in life, things do not stay perfect forever. At some point, something happens and the stock market will tank. It will reverse. It will do a number of pullbacks actually from time to time as it continues higher. So the question is, if you can identify before this reversal downward actually takes place, this is an insane skill to have, considering that right now the markets are trading at their all-time highs or close to the all-time highs. Look at NASDAQ. Just a day ago, it was at the all-time high. So this is an incredible skill that you could have, because the bull markets, they don't last forever. So when they reverse, and as a matter of fact, I'll show you plenty of opportunities where you actually don't have to wait to utilize these strategies before they reverse, right? In other words, we don't necessarily have to have a market crash for you to utilize these strategies of divergences, right? You can utilize this even as the market keeps going higher and higher. So in the second type of trend reversal opportunity is when the market keeps trending lower and it reverses and it starts going higher. Okay, so very important, again, that you grab a pen and a paper and take notes as we go through this. Now you might say, well, what's the big deal with these trend reversal opportunities? Well, if you are a trader, if you're a student of the financial markets, here's the greatest importance of learning the trend reversal opportunities. It is because the biggest fortunes in the stock market were made from identifying trend reversal opportunities before those reversals actually took place. And here, I'll just play a quick little video here for you so you can see what type of fortunes people were actually able to accumulate by being able to develop this skill of identifying the trend reversal opportunities before they happen. Here it is. Check it out.
Number 1. Jesse Livermore. His first significant trade was shorting stocks just before the San Francisco earthquake, which made him $250,000. He then shorted the 1907 market crash and made $1 million. Then he made $3 million shorting wheat in 1925. The big money came when he shorted the entire market during the 1929 crash and made $100 million. 2. John Paulson. John Paulson was one of the very few people who predicted the housing bubble burst in 2007 and 2008. He shorted the subprime mortgages just before the financial crisis, and his hedge fund made around $3 to $4 billion. Number 3. David Tepper. In 2009, just after the financial crisis hit, everyone started selling bank stocks. David Tepper, on the other hand, bought huge quantities of big bank stocks like Citigroup and Bank of America. By the end of the year, when these stocks bounced back, Tepper's hedge fund netted $7 billion, of which $4 billion went to his own pocket. Number 4. Jim Kanos. Jim Kanos analyzed the company Enron for 2 years from 1999 to 2000. He came to know what the company was lying about, pretty much everything, and shorted the Enron stock when the stock was at $90. Jim Kanos was proved right when Enron's scandal became publicized and the company filed for bankruptcy in December 2001. In the process, he pocketed millions. Number 5. Paul Tudor Jones. He used technical analysis along with historical data to predict the market crash in 1987. He was massively short on stocks and gained around $100 million when the Dow took a dip of 22%. Number 6. Sir John Templeton. 8 years before he died in 2000, just before the dot-com bubble popped, he shorted a whole bunch of internet stocks. When the dot-com bubble burst, he made $80 million in a few weeks. Number 7. Andy Krieger. In 1987, just after the Black Monday crash, investors dumped the US dollar, which is generally considered a safe currency, and rushed to other currencies. 32-year-old currency trader Andy Krieger realized that the New Zealand dollar, also known as Kiwi, was dangerously overvalued. He shorted millions of dollars worth of Kiwi, netting his fund $300 million.
Hey, quick question. Did you notice out of the 10 best trades and biggest fortunes created out of this short video clip, how many of them were made on the first type of reversal? on the bearish type of reversal and how many of them were made on the bullish type of the reversal. If you were paying actually close attention to the video, you should have been able to identify that 9 out of best world trades were creating fortunes as a result of a bearish reversal opportunity. In other words, the money was created when a commodity or a stock or a market overall has fallen drastically. Now, only one, David Tapper, the third trader on the list, created a fortune from a bullish trend reversal when the banking stocks fell, and he caught them at the ultimate lows in 2008, 2009. So 9-to-1 ratio. Now, do you understand how important it is to actually study the bearish trend reversal? And here's where I come in. My area of expertise is predominantly in identifying bearish trend reversal opportunities. In other words, shorting stocks for utilizing options before they drop and keep falling lower. Now, in simple words, in this course, I will teach you how to make huge profits when stocks fall. Considering the fact that the markets are at their all-time historic highs, this is a very timely and a very valuable skills to acquire right now. So chances are, if you're watching this course, you're probably familiar with my trading record of taking 12,000 to 466,000 in less than 7 hours by placing roughly 30 bearish trades consecutively over the course of 6 hours and 38 minutes in just one day. That's right. Now, 29 out of those trades were highly profitable, which means my accuracy was at 99.5%. So in this course, I will share with you specifically what I look at in identifying trade reversal opportunities that help me generate day trading results like that. I also specialize in swing trading, where I hold my positions longer. Anywhere from 48 to 72 hours is ideal, because by utilizing these trend reversals, where you really can gain some huge results is when you actually catch the trend reversal at its very top, and literally if that trend reversals last consecutively for 3 days, you can stack up returns in the amount of 1,000%, 2,000%, 3,000 to 5,000%. So that is the type of information, if you master what's in here, that you will ultimately be able to do on your own. Okay, now most of the people ask me this, well, hold on, just don't we need a market crash to generate these type of returns? This just sounds too good to be true. Well, the reality is the answer is no. Again, if you watch my course 12K to 466 in under 7 hours, you will know clearly that on that day there was no market crash. As a matter of fact, Dow Jones was going higher, S&P 500 was going higher, NASDAQ was actually showing some signs of weakness. So most of the people believe that huge money is to be made from shorting stocks when market crashes. Now, that is a general misconception. Again, when markets crash, actually, sometimes it's too late to short because in many instances, you will run into 3 problems. Problem number 1 could be that it's going to be, if you actually short in stocks, if you're not dealing with put options, it's going to be simply impossible to borrow stocks to short. When it becomes apparent to everybody that the market is crashing, nobody's going to want to borrow you the stocks, or maybe all the stocks that were available are gone. And so you simply may run into inability to short. Number 2 is you're going to have a certain limitation, because once it's apparent for everybody, all the market participants, what direction the market is going, and if it's fiercely dropping, with gap downs every day and so on, then your put options prices and premiums are going to become insanely high. So to avoid this, okay, you really need to master the material in this course. Okay, so number 3 problem could be the fact that actually, if you look at the history, many times governments actually during a market crash, they will actually create a law that will prohibit shorting stocks for the duration of the crash. And so the last actually historic example was in China just a few years ago in 2015. The economists and the studies that were done actually show that it does exactly more harm to the financial markets because the markets actually lose their equilibrium entirely. And so it's questionable to whether that's going to be utilized in the future. However, again, this could be an issue if you're trying to short stocks or buy put options, in a market environment where certain governments, depending on where you're located, where you're trading, could simply prohibit shorting stocks during the time of a crash. So what's the main point here? You have to own a position in your stock before the market actually crashes to lock in huge gains. So how do you do that? Well, it's by identifying trade reversal opportunities before they actually happen and take place.
Come here, baby. Sit down.
Trend reversals. A few things to understand. Okay, trend reversals could be implemented and applied on different time frames. You can use it throughout the day, in other words, intraday, if you're a day trader. You can use it on a weekly basis if you're a swing trader, monthly basis, annual basis, and longer term basis. So trend reversals can be applied to individual stocks, indexes, commodities, Bitcoin, or anything that has a chart and is trading on a decent volume. So implications of utilizing these chart information in the scores, the utilization is endless. You can take this outside of stocks and apply it to anything that has a chart. Now, important, okay, please write this down, okay? Study charts on different time frames before making a trading decision. Okay, if you're planning on entering a position, let's say for a few weeks, it's important to analyze not just the 1 day, 1 minute chart. What's more important and more relevant is a different time frame to the type of trading that you're doing, which in this case would be the chart for last week, last 30 days, last 6 months, and even last year, since you're going longer term. On the opposite, if you're day trading, then more weight and focus should be given to the 1 day, 1 minute chart, 1 day, 5 minute chart, 4 day, 5 minute chart, 10 day, 30 minute chart. But also it's useful to know the 30 day, 90 day, 6 month, and 1 year as well. Why? Well, for example, to learn the historic daily trading range, what I call is DTR, daily trading range. You have to simply understand the historic daily trading range of a stock to be better prepared to select, when you're trading options, a better strike price, okay, and determine the best exit point. So it's, again, write this down. Don't only just look at a one type of chart. Make it a habit to look at multiple different time frames. And your key giveaway is going to be if those different multiple time frames pointing out to the same thing, then definitely take action. Now, here's an example of a few different type of charts for those of you guys that are new, okay? So here's an example of a weekly chart of Facebook. Okay, you remember when all the crazy stuff was happening with the Cambridge Analytica, okay? And until that actually took place, look, everybody was insanely bullish on the stock, right? And so when that started taking place, the stock started dropping like a rock. You can see complete trend reversal opportunity from the stock being traded in the 190s, dropping all the way to 149 at 1.150. Okay, now this is how the chart looks on a weekly basis, and a lot of times, look, if you don't have a brokerage account, or if you just simply want to follow and use the same format that I'm using, I'm basically utilizing stockcharts.com. You don't need an account set up. You don't need a paid account. You can use them for free. So if you go in there and you type in a ticker symbol, you'll have a little scroll bar thingy right here. You can select daily or weekly. So on the weekly, you're actually going to be able to go almost 2 years back. And so this chart is quite long term. So it represents the data all the way from 2016 going until recent months of 2018 in April. Okay, so that's the weekly chart. This is how the daily chart will represent the same price action. Okay, so this is the same drop, but clearly you're able to see a lot more detail. And again, what I'd like to emphasize here is nothing drops in one straight line. Just think of the stair steps. Think of hills and valleys. Okay, on the previous chart, it looks like it's just pretty much one big drop. But in reality, if you look at the daily chart, first it dropped here, then it went here, then it dropped again, then it got here, and then it dropped again. So overall, it's a drop from 195 all the way to 150. Okay, but clearly we see that was happening just in one straight line. And there's a great importance to that. So just write it down and keep it in the back of your mind as well. Okay, now this is how the chart looks for Facebook. Trend reversal on 1 minute, 1 day. Okay, so when it falls from 185, in this case, that particular day, it fell, I believe it was a Monday, it fell from 185 to 170 in just a few hours. You can see there it was. There it falls right here all the way to, so that's a $15 move. As a matter of fact, I had some short positions that day, and it was absolutely incredible because typically Facebook is a lower volatility stock, so it doesn't trade $15 a day. This was actually historically the largest move, dollar value-wise, that Facebook has made in one given day. So needless to say, when nobody expects such a move, your options are priced incredibly cheap, especially if they're out of the money, okay? Especially if they're significantly below the price where it's currently traded. So you were literally able to buy those put options pennies on the dollar, and you were able to sell them at easily 2,000% returns that day. So that's how incredible that trend reversal opportunity was. I'm showing you different time frames. So again, the point here is to make sure whether you're day trading, whether you're swing trading, or whether you're a long-term trader, take a look at the minute chart, take a look at the daily chart, take a look at the weekly chart, take a look at the monthly chart. Just go and look at a variety of charts and basically, take different angles of views. And on some charts, when you analyze a stock about making a particular trade, all the signals are going to coincide on these multiple charts. Okay, so to summarize the subject of looking at multiple time frames, to increase your probability of a great trading decision, ideally you want multiple time frames to point to a similar development in the next move of the stock. For example, if your daily chart is pointing to one thing, but weekly chart is pointing to a totally different thing, then you may want to look for more confirmations before entering such a trade. Later in the course, I will give you some specific examples in a few stocks. One of them is going to actually be a UPS, where they clearly demonstrating some really interesting fake moves. And I'd like for you to actually be able to identify a fake move from a real move. Understanding the trend. Before we look at details on how to identify an upcoming reversal of a trend, let's first take a quick look at what the trend actually is. So in this case, we're looking at an uptrend. Okay, so trend lines are quite simple. All you got to do is connect the lowest points on the chart. In this case, it would be this point right here, I highlighted in blue. And if you hypothetically to draw a line, or you can actually literally draw a line through this, if your line is pointing upward, then you're an uptrend. Okay, what makes this such a solid case of an uptrend is it actually coincides, this line right here is the 50-day moving average. And generally speaking, when the stock price is actually trading above the 50-day moving average, the stock is considered to be trading in the uptrend. Very important, if the 50-day moving average line is above the 200-day moving average line, which the 50-day moving average and 200-day, they're just average, they're the averages of the prices of that stock over 50 days and over 200 days. So if the stock is trading above the 200 and above the 50, then clearly it's in a definite uptrend. Just please pay attention that nothing as far as the stock market goes straight up consistently forever. Okay, so keep in mind of the stair-step formation. And so in this case, every time it pulls back to this line, it jumps off of this line and keeps high highs and high lows. Just remember, stocks never go up in straight line, right? And just think of it as stair stepping and climbing mountain peaks and valleys. Draw an imaginary straight line to connect the peaks to determine the trend at the same, and the same with the lows. So here are your higher highs, higher high, another high high, another high high, and here's your high low, high low, high low. When you have a combination of higher highs and higher lows, that's another way of basically characterizing an uptrend. Okay, so why should we care about the trend lines? The importance of trend lines for traders is the following. Institutional investors will typically buy the stock aggressively at its 50-day moving average if the stock is in an uptrend, at what is often described also as a support line. You probably have heard that for the last decade, literally, the most popular term used in trading has been buying the dip. So what does that mean? Well, as you can see at the high lows right here at point 1, 2, and 3, banks come in and they use this high low points to actually accumulate their positions, to buy the stocks, or in other words, also known as buying the dip. So if you keep hearing the term buy the dip, that's been the fashionable madness of the last 10, maybe now 11 years going on in the market. So buy the dip, take a look at this picture, and you'll know exactly what buying the dip is. What is support and resistance? Draw the lines mentally and print out the chart and draw them with a pen to better grasp the concept of support and resistance, okay? So the 50-day moving average line, in this case, coincide with the light blue support line, okay? So if you draw the line through the higher lows, you'll get the support line. And again, this coincides with the 50-day moving average, and the resistance line would be if you were to draw a line through the higher highs, you'll get this orange line. And so an interesting point to notice, an indication of a divergence could be if these lines start to narrow. Okay, if this distance between the resistance and the support starts to narrow, this could be actually an indication that a huge move to the downside or upside is coming. So take a notice of that. All right, example of a broken resistance level, okay? As you can see here in this case, stock BGNE, Gene Pharmaceuticals, is breaking through this range right here. And at this point, you don't see any banks coming in and scooping the stock right here. Also, notably, it's doing it on a very high volume right here. So the stock is breaking through the support line, which is this blue line. As you can see, historically, it always bounces. As a matter of fact, historically, it literally doesn't even touch the support line, besides maybe this one instance right here. So it actually keeps stopping just a little bit above the support line each time. But in this case, not only it touches the blue line, but it breaks through it. And when it breaks through the support line on huge volume, okay, this is actually an indication of a trend reversal, because at that point, the banks are not scooping up the stock here. They're actually participating in heavy distribution or heavy selling at the stock, which is also later you will find out when we're going to talk about accumulation distribution. You're going to be able to confirm that right here. The huge volume is the key when you're talking about a stock breaking through a key support level. Let's take a look at the downtrend. The downtrend is actually the opposite of the uptrend. It will be making a series of lower highs and lower lows. So on this chart of REGN Pharmaceuticals, you have a high right here. Well, the next high point on this chart is actually lower than the previous one. And you can see the falling high on the chart is lower than the preceding high, and that trend continues. So we have a series consecutively of lower highs. Now, if we look at the lower points on the chart, you have a lower low right here. You have another lower low in relation to this one, and so on. So we have, when you have a situation of lower highs and lower lows, if you were to draw a line right here, it's going to be a downward trending line, which again in this case almost coincides with the 50-day moving average. And if you were to draw a line through the lower lows, you will also have a line that's parallel to the other line, and they're both going down. They're both falling, they're trending lower. Therefore, the term is the downtrend. In this case, the 50-day moving average became the resistance and created numerous opportunities to short the stock. So if you were to simply observe and draw the line for this resistance level, every time the stock got here, it was actually a very, very safe time to time this trend reversal opportunity, right? Because each time it touched this resistance level, it actually fallen back literally within just a couple of days, starts its downward trend. So trend reversal, after it goes higher, it looks like it's about to just keep going higher, but no, it stops right there on the resistance. And honestly, when that happens multiple times, you can find numerous trading opportunities as it keeps doing the same thing over and over again. So as you can see here, it trades at a level of $540, and here it trades at a level of $381. So you had a ton of opportunities shorting the stocks. And of course, if you were trying to catch a round trip trade, which is actually quite sophisticated, because now you're focusing on both sides of the equation, shorting the stock and buying it at these support levels, okay, which is a little bit harder to do than just focusing on one thing, which is shorting stocks or just buying the dips, right? But if you were to do that consecutively, this is a really great stock to trade. REGN presents some phenomenal opportunities.